One of the topics we want to talk about as we start the 2016 market year, as we know, we literally came to work, and on the way in on the radio and the futures market like before, China was already in circuit breaker mode in a crash, 7.5% circuit breaker. They probably need a bigger circuit breaker than 7.5%. Clearly, the engine of global growth that is China for the last 6-7 years isn't going to last forever. And the transparency behind what really is real growth and what's kind of paid for growth, and those 65 million empty apartments and train stations to nowhere, it isn't just hyperbole. There are some realities of the fact that if you build it doesn't always mean it will come. And China is a classic example of a massive kind of punch bowl market, a lot of great things happening in real estate and markets, and then suddenly it stops. And when it stops, it affects a lot of things. Clearly, all that debt that China's been taking in the last 7 or 8 years, all that infrastructure building, all of the CapEx and all of that market movement has ramifications. And when China slows down, the world slows down as well. There's a lot of interaction there. Where we see that playing out is in a lot of places. The kind of interaction between what's happening in China and their monetary policies there, printing and debt. Same thing we did in the US, printing, debt, low rates. All that printed money, all that easy money on the ZIRP policy of the Fed meant a lot of publicly traded companies or a lot of PE companies, or even private companies were taking a lot of loans and doing a huge amount of CapEx investments in commodities. And so the commodity discussion is worth also tying into China and also in the US. It's not just about commodities, it's about easy money. When you have easy money, you invest usually poorly for a long period of time, and you overinvest. Whether it's bauxite, coal, zinc, iron, copper, and of course, oil. You see a frenzy. And with that frenzy comes a lot of fun until the frenzy's over. And we're seeing that in oil. I want to get some of your thoughts on oil because it's not just a commodity play, it's an aftershock play. This easy debt, this easy money, this easy credit has led to a bubble in oil. We've got massive amounts of oversupply, whether you're looking in Saudi Arabia, the US, the Middle East, Iran, everywhere. By every count here, our inventories are at all-time highs, whether it's Cushing, pad 1, pad 2, pad 3. Massive amounts of inventory, probably hitting to the point where we're going to hit oversupply in terms of inventories. We're going to hit storage limits, and then oil will probably go down even more. So oil is a symptom of the same things we've written about and talked about and you've written about. Tell me more about the oil opportunity as it ties into the fact that there's oversupply here, and then with China slowing down, that demand is missing and the supply is over exuberant. So that's a perfect storm for the price of oil.
Well, let's start with China, and of course the stock market fell so much the first day that, as Matt said, hit the circuit breaker. Let's be blunt, that means they had to shut the markets down. That's a big deal. I mean, they shut them down for the rest of the day. But the problem wasn't so much the markets. They're volatile. Let's face it, Chinese market has been volatile all last year, and actually it was one of the best performing markets of the year. So volatility itself doesn't bother me as much with China, but the reason it went down was not just typical volatility, but very bad news on their manufacturing. Not just news that had come out from China on their manufacturing indexes, but also South Korea, which has actually seen declines in exports. They're one of China's biggest trading partners. They've seen declines in exports every month this year. So you're seeing a lot of slowdown issues, and that is leading to, as you said, the whole global issue of oversupply. Cheap money is definitely part of the reason we have the oversupply. In fact, they said miners had often had a hard time raising money to expand their mines, and then as the money got cheap, especially the last few years, miners went wild. They were buying companies, they were expanding mines. It was phenomenal. They loved it. You know, kids in candy shops. Oil the same way. They all thought China keep growing. It's a great super cycle. It didn't. And partly because, frankly, since 2008, as you say, most of China's growth has been from, debt, and not so much earlier, where it was more based on productivity improvements, which they had a lot of. And those will remain. But the debt bubble is not, and it's going to pop, and it is popping, I think much faster than China says, as we all agree. And in particular, I think it does lead to a great opportunity in oil, because the bottom line is that oil doesn't cut off immediately, and I mean oil on the short side. I love the oil industry, but I think the short side is still there. Oil hasn't hit bottom, simply because oil production doesn't cut off very quickly. Oil drilling cuts down a lot. We've cut drilling 60–70% in the US. Only about 15% around the world, though. Around the world they're still drilling. We're cutting it back, but nobody shuts off oil wells. Nobody, just because you've we'll see $20 a barrel, and I think it can even go below that. Quick reminder, when we hit our production, well, when we hit the 1981 bust in oil, which I remember pretty well, and we cut drilling by 50%, by 1984, our production was actually up in the U.S. Didn't go down at all, despite that massive cut in drilling. So something to keep in mind, production takes a while to go down, demand can go down much quicker, as I think we're seeing in China, and that's kind of the bottom line problem. And creates a lot of opportunities both on the oil side, and I still think mining's got a ways to go too. Yeah. So should be an interesting year in those areas.
Yeah, no, and just to kind of recap, keep it simple. Always keep it simple, whether they're talking about stocks or bonds, or they're talking about commodity trades or mining trades. It really does come down to supply and demand, and it comes down to the fundamentals, which have been so distorted by central bank policies and easy debt.
Not just in the U.S., but
not just
China.
in the U.S., but everywhere. And behind every crisis is a debt crisis and easy money. What we have here in the commodity of oil in particular is a classic case of massive oversupply and a lack of demand. And that might be some bumpy moments in that trade here and there, but the trend is clearly down, and there's no way that demand is going to suddenly increase in the next couple of years with the headwinds we're facing in the world, and the supply just keeps on pumping. No pun intended, so that's oil.
There you go. Thanks.